Every major financial crash has the same fingerprints: a sudden, unexpected collapse, a flood of panic across headlines, and then, like clockwork, the same institutions step in as saviors, only to walk away richer than before. But what if those saviors aren't rescuing the system? They're resetting it. What if the crashes themselves are part of the plan? Today, we pull back the curtain on the invisible hands that have quietly orchestrated economic chaos for over a century, profiting from every collapse, every bailout, and every so-called recovery. This isn't about speculation. It's about patterns that repeat through history, patterns that always end the same way, with power consolidating upward and ordinary people paying the price. The birth of a controlled economy. Our story begins in 1913. That year, a small group of bankers and politicians met in secret on Jekyll Island, Georgia. Out of that meeting came one of the most powerful institutions in human history, the Federal Reserve System. The official reason? To stabilize the economy and prevent banking panics. The real result? A private banking cartel gained control over the creation of money itself. By design, the Fed could now expand or contract credit at will, deciding when to feed the economy and when to starve it. They became the invisible hand behind every boom and every bust. When money is cheap, speculation soars. When money tightens, the bubble bursts. And each time, wealth transfers quietly from the public to the architects of the system. The rise, building the machine. Through the roaring 1920s, credit expansion fueled an unstoppable stock market. Banks lent freely, the Fed kept rates low, and ordinary Americans jumped in, believing prosperity was endless. Then in 1929, it all came crashing down. Stocks plunged, banks failed, millions lost everything. But behind the chaos, the biggest banks, those tied to the same circles that designed the Fed, were quietly buying up assets for pennies. J.P. Morgan, Chase, and others consolidated control over entire industries. It was a devastating crisis for the people, but an opportunity for the elite financiers who helped trigger it. In the aftermath, new regulations were written, again by the same insiders, under the banner of "Never Again." But the system didn't change, it evolved. The 1940s through 1970s brought new global structures. The Bretton Woods Agreement, the IMF, and the World Bank, institutions created to stabilize economies worldwide. In truth, they extended the same model: control through debt, policy, and crisis management, this time on a global scale. The breaking point, when money stopped being real, fast forward to 1971. President Nixon stunned the world by removing the U.S. dollar from the gold standard. From that day on, money was no longer backed by anything tangible. It became debt, pure and simple. Now, central banks could print unlimited currency, and governments could borrow without restraint. At first, it felt like freedom. But that freedom came with invisible strings. Each new dollar meant more debt. Each bailout meant a deeper dependency on the system that created the problem. And as credit expanded through the 80s and 90s, financial markets became addicted to cheap money. Every small dip was met with intervention. Every risk was socialized. Every failure was rescued, using taxpayer money. It was the ultimate safety net for the elite. The fallout: crashes engineered, bailouts monetized. Then came the 2008 global financial crisis, the modern masterpiece of manipulation. Years of reckless lending, securitized debt, and financial alchemy brought the system to the edge. But while millions lost homes, jobs, and savings, the same institutions that caused the collapse were rewarded. The Federal Reserve injected trillions of dollars into the banking system through quantitative easing. Wall Street recovered within months. Main Street took more than a decade. But here's the secret few noticed: the bailout wasn't about saving banks, it was about expanding control. By flooding the system with liquidity, central banks became the largest buyers of government debt, corporate bonds, and even stocks. They didn't just stabilize markets, they owned them. And once again, after the panic subsided, inequality hit new highs. The rich got richer, the cycle reset, the new era, the game goes global. After 2008, the playbook became clear. Crisis, bailout, consolidation. Repeat. By 2020, the next black swan appeared, the pandemic. Markets crashed overnight, governments shut down economies, and yet, within weeks, central banks printed more money in a single year than in the previous 5 decades combined. Corporations were rescued, billionaires' wealth skyrocketed. Meanwhile, inflation quietly stole purchasing power from ordinary people, another invisible tax. Once again, the same invisible hands profited both from the collapse and the recovery. Today, global debt sits above $320 trillion. Central banks hold record levels of assets, and digital currencies, like central bank digital currencies or CBDCs, are being prepared as the next evolution of control. With programmable money, the same institutions that caused the crises could soon decide how and when you're allowed to spend your own cash. Sound far-fetched? So did the Federal Reserve in 1912. The pattern, history's echoes. If we look back, the pattern never changed. 1913. Centralized control begins. 1929. Wealth transfer through engineered collapse. 1971. Money detaches from value. 2008. Bailouts become the business model. 2020. Money printing reaches infinity. Each event was sold as an accident, a necessity, or a rescue, but each one concentrated more power in fewer hands. Today, just 1% of people control over 45% of global wealth. That isn't a coincidence. It's a design. The system was never meant to be stable. It was meant to be cyclical. Because in cycles, control renews itself. Lessons. What we can learn. So what do we take away from all this? Lesson 1. Every crash has beneficiaries. When you follow the money, you see the same institutions profit from both fear and recovery. Lesson 2. Debt is the product. Modern economies don't thrive on production. They thrive on perpetual borrowing. Debt isn't a flaw, it's the engine. Lesson 3. Stability is the illusion. Bailouts, stimulus, and regulations promise security, but often just reset the same exploitative system under new branding. The warning, what comes next? The next reset won't look like the last one. It won't start with a stock market crash. It might begin with a currency transition, a digital dollar, a global debt jubilee, a green restructuring of the economy. Whatever form it takes, remember. Each reset brings new rules, and new rules bring new rulers. The real question isn't if the next collapse is coming. It's who will own the system that replaces it. If you learned something new today, if this changed how you see the world, then don't let it end here. Like the video, share it, and subscribe for deep dives into the hidden architecture of money, power, and control, because the invisible hands are still moving. And the first step to breaking free is seeing them.